Hello, everyone, and welcome. Thank you for joining Foley and Lardner for part 2 of the Monetizing Campus Energy Assets webinar series. If you have any questions about any of today's topics, we invite you to type them into the Q&A box, which is located on the left side of your screen. We will be answering questions throughout the program. If you experience any technical difficulties with the webinar platform, please refresh your browser or see the webcast help guide on the bottom of your screen, which is designated with a question mark icon. As a final note, there is a short survey located on the right side of your screen. We would greatly appreciate your feedback on today's webinar. And now I will turn it over to Jason Allen to begin today's program.
Hi, everybody, and welcome to part 2 of our webinar series. We've got a great panel set up for you guys today to talk about lessons from the real world in campus P3s. I'm Jason Allen. I'm a partner at Foley and Lardner and co-chair of our energy industry team. My co-moderator today is Laura Bilas, who's a partner and chair of our national finance practice group at Foley. So we're really excited to moderate this panel. Just quickly on the intros, I'd like to introduce our 2 panelists. Santanu Khan, who is Vice President at ENGIE North America. He's head of development campuses, cities, and communities. I had the great fortune of working with Santanu on the acquisition of Maytep with Axiom Infrastructure, which is a microgrid and district energy system serving 6 Harvard-affiliated medical institutions in Massachusetts. That was a tri-generation facility. But Santanu is one of the most active, along with ENGIE, active players in the space. Santanu, do you want to chat briefly about your background and what you do for ENGIE?
Sure, thanks, Jason. So yeah, I'm Santanu Khan. I head up our P3 development effort for ENGIE in North America. I have been with ENGIE for the last 13 years, and my focus has been mostly infrastructure development, P3, large M&A, and project finance.
Thank you, Santanu. And then also we're joined by Thomas Mulvihill, who's the Managing Director and Group Head of Infrastructure Finance and Public-Private Partnerships at KeyBanc Capital Markets. Thomas is also one of the most active bankers in the space. He just recently closed on the Fresno State P3. Thomas, do you want to chat briefly about your background?
Sure. Thank you, Jason. And good morning, everybody, or good afternoon, I should say. Yeah, Tom Mulvihill with KeyBanc. And yeah, we were fortunate enough indeed to close that Fresno deal last Friday. And we were also fortunate enough to work with ENGIE on the University of Iowa utility concession transaction. So both the monetization and the kind of greenfield new construction models. And it's an area that we're seeing a lot of interest in, and look forward to today's discussion. Thank you.
Great, thank you. All right, let's get right into sort of lessons from the real world, and we'll get right into some of the macro issues on campus P3s. My first question for the panel: what types of campuses are good candidates for a P3? And why don't we start with Santanu on that question?
Sure, Jason. Thank you for that. That's a good question. Actually, my answer to that would be all campuses are actually good for P3. It just depends on what the university's higher rates and then the large campuses they want for themselves. These days, as you can see, Tom just mentioned University of Iowa, and then there is also Fresno State. They have different objectives. Fresno State is a much smaller campus compared to Iowa, but their objective is mostly on the side of design, build, finance, and maintain of a specific utility system, whereas Iowa is more on the monetization side. They want to get a partner for a very long time who can actually run the campuses, implement new technologies, bring sustainability, resiliency to the campus. So in the end, I think all campuses are good for P3 development. Large campuses obviously have much more options, expansion. There are things to be done in a large campus, but at the same time, small campuses also have opportunities to improve. So in the end, it just depends on what really the customer, the owner of the campus.
I would agree with everything Santanu said, and maybe all I'd add is the focus that I'm seeing a lot in the market. I'm guessing a lot of folks on this call have as well. Is it's a lot around universities, and that makes sense. A lot of these universities are like small cities and they've got centralized power needs and generation. But healthcare is an area where we certainly think there could be a big expansion. Many of the hospitals themselves are campuses with big daytime populations that consume a lot of utility services. And so we like that space. There are some, although at least in my understanding, there are some, but not as many kind of state and municipal campuses. But for sure, as Santanu said, any one of these areas where you've got, a good kind of population group and they're a big consumer of these services, there can be a way to, and it doesn't even have to necessarily just be centralized. It's more just you've got, really a single kind of entity that has a need to provide utility services to a larger group of folks. And whether it's centralized or somewhat decentralized, it's got renewable elements to it. I think there are quite a few different campuses that for sure are good candidates for P3s.
Just following up on that, types of campuses, let's just talk briefly about, we hear this term a lot lately, smart cities. I'll throw this to you, Shanu. How do you see that? How does that work into this when we talk about campus discussion? I notice that Las Vegas or out in Nevada, they're talking about a smart city right now. How do you see that playing into the P3 area?
Yeah, I think that's a great question, Jason. And we have been actually focusing on smart cities, and as Tom mentioned, all these campuses are in the end, small cities. If you think about Ohio State, there are, over 400 buildings and over 200,000 people in the campus. Same goes for Iowa. It's probably much smaller than Ohio State, but, in many senses, they themselves are like small cities in certain sense. And as far as really smart city part of that is concerned, we are talking about green mobilities. And that's a big part that is to greenify the campus. That's a need that is coming up. Really providing flexibility into the utility distribution system as well as utility generation system so that you can add more expansion to this and making sure that you are generating and consuming more efficiently. And that's what really all that comes with the smart cities. Of course, there is a question of how do we make the communications better, making sure, more and more things are more computerized, digitalized. And these are some of the things that we are actually looking to implement, provide digital infrastructure for mid to large cities and communities, and this is where we see big improvement is coming in the future.
No, thanks for that. Which leads me sort of into my next question. I think a good segue. Thomas, we'll start out with you. What are the drivers for a campus seeking out a P3? Is it monetization? Is it modernization? Is it sustainability, energy efficiency, other reasons? Why don't you walk through some of the reasons that sort of drive campuses in seeking to sort of enter into a P3 relationship?
Sure, and I'll be happy to. And, as Shantanu mentioned, right, Fresno and Iowa are almost kind of good examples of two universities having very different goals and objectives, what they were looking to seek out of partnering with the private sector for their utility needs and services. And so, and prior to my time at KeyBanc, with Key almost 4.5 years now, but prior to that, I spent about 8 years at KPMG, where I was more of an advisor to owners of infrastructure, including universities, and helping them think through, when do you partner? What are those drivers that would make me want to do a transaction like this? And so we spent a lot of time thinking through those issues. And certainly, you've got certain universities that I'll say have, well-maintained, probably still need some repair, but they have generally well-maintained utility systems. But they've got a large, daytime population. They've got large need to provide services to folks, and and for them, it is more of here's an opportunity to monetize an asset and raise capital for other purposes. So maybe for projects that don't have let's say, a revenue stream assigned to them, and so they can help either just shore up their own balance sheets or help deliver new academic facilities or a new library or other things like that. So there are certainly those, and we've seen, in the higher ed utility space, there's been more of those thus far, right? Obviously, Ohio State, Iowa, Idaho, and we've got a couple others it looks like that are going to coming down the line as well. But for Fresno, that wasn't their story. Their story was, we've got an old system, we've got deferred maintenance, we need to remove this thing and put in a whole new one. And for a lot of universities, and I'm guessing for healthcare institutions as well, things like providing utility systems are not core to their existence, right? It's academics, it's healthcare, but providing utilities is necessary, obviously. And so, but because of the way they've maintained these systems, they've had a tendency to get a lot of deferred maintenance. They've had a lot of failures and doing emergency repairs, which are the most expensive. And because they haven't made investments, there's been, there are a lot of inefficiencies. And so the desire of saying, I can potentially just have a single party come in, replace my system and take over the responsibility for ongoing utility services and take this kind of nightmare situation I might have gotten myself into off my hands. I think for some universities and healthcare providers, that could certainly be the case, that it's just more of this is a must-have, but it's not core to our mission. And we need somebody to help have, sustainable utilities, reliable utilities. We want to consume efficiently. We want to generate efficiently. And so I certainly think that those are a lot of the key drivers that we see, in driving, why folks choose a P3 or a utility P3.
And I fully agree with that, Tom. That you described very well. Just to add a few things to that, also risk transfer is a big one, right, for the higher ed healthcare systems, because healthcare, so obviously they want resiliency at the campus, higher ed obviously want resiliency, but also sustainability is a big part of the goal, and risk transfer of the operational system, which is not their core competency. So that's one part of it. What we have seen for higher eds as well, a big part of the P3 is academic collaboration, experiential learning, bringing in a partner, really not a provider, but a service provider, but a partner who can actually grow with the university, with the healthcare system in the future, and then also provide, other needs like experiential learning.
Great discussion. Let's jump into that. We've talked about who were the good candidates. We talked about some of the drivers. Now let's talk about structuring. A campus decides, hey, this is something we want to entertain. Let's talk about some of the typical structures that we see out there. Obviously there's an acquisition, off-take type arrangement. You could have a sale leaseback, you could have a straight O&M, you could have a long-term lease with concessions. Shantanu, why don't we talk through some of the various structures that are available?
Mm-hmm. And that's a great way to put it there, Jason. I think you pretty much listed everything that is out there in the market. And one thing I would like to say is, in the end, really these things are ranked and ordered based on the risk transfer, right? So if you think about straight O&M agreement, I can give you a couple of examples. For example, ENGIE right now has O&M, long-term O&M agreement with College Park campus. That's a pure O&M agreement. It has started with something else. It's a P3 in certain sense, but ENGIE's responsibility is mostly providing operation and maintenance. Acquisition and offtake is great. That's higher on the side of the risk transfer. You mentioned Longwood facility. That's one way to look at it. And then you have design, build, finance, operate, maintain, or sell this back. That's probably the next other type of agreement structure that we have seen and we have worked with. Fresno State is a great example of DPFOM. You have a 30-year contract and you do more and more risk transfer. And then it comes to long-term concession and leasing arrangements. That is probably the highest kind of risk transfer from the university campuses to the to the provider, service provider, the partner here is, Ohio State, Iowa, Idaho are great examples of concession agreement where, it's a real partnership in a sense that you are providing all services in under one single umbrella for 50 years, and you are working with the university to modernize and make things better every day at the campus.
Yeah, the only thing I'd add, I think that was spot on, and I agree completely with Santanu there. I think, the important takeaway, I think, is for those owners of infrastructure on the call, look, you've got a lot of tools available to you and a lot of ways to structure deals that meet your goals and objectives. And, there isn't just a P3 isn't a single thing, and everybody's got to do it that same exact way. And so there's a lot of different ways you can allocate risk and or develop arrangements and models that, again, meet your needs and suit what your situation is. So it's different than some of the more mature markets, more mature P3 markets around the world that we see, where it pretty much is a P3 is kind of one type of solution. And whether it's a bridge or a road or a university project, it kind of looks the same. It's this model, where in the US, it's, I think, a broader range and much more customizable, which I think is much better for the owners ultimately.
Yeah, just a quick follow-up on that. Let's talk about, when we're structuring the payment structure. I mean, obviously, these have to be financeable. Santanu, they've got to earn a rate of return for you, and for the university, it seems folks are very focused on the upfront payment versus sort of a smoothing payment, a different structure over a period of time. Let's talk a little bit about it. Is that just an arbitrage play? How do you look at those payment structures, and just talk the audience through how those work?
Yeah, sure. I mean, upfront payment is one way to look at it, and universities, Ohio State, Iowa, Idaho, all of them got an upfront payment out of this. Fresno doesn't have an upfront payment, but it's still a full DBFOM structure where the partner finances, the private player finances it. So upfront payment, while it could be important for some universities, but there is no one way to structure this, like Tom mentioned. You can look at it in different ways, and in the end, it's like you said, upfront payment is an arbitrage play. And some universities like it, but there will be other universities that don't care about upfront payment. But in the end, what the goal of these universities and higher ed and healthcare systems are, they really want to get a partner to modernize the system and place their utility infrastructure in order so that they are ready for 21st century. In terms of sustainability, in terms of resiliency, in terms of other goals they have in their mind. So upfront payment is just a derivative of some of these transactions, but not a necessary item.
Are you Santanu, just a quick follow-up there before Thomas weighs in. Are you agnostic as to the structure from a provider standpoint?
Absolutely. We are fully agnostic. We don't care whether university wants an upfront payment. If they want an upfront payment, we'd be happy to structure the transaction in that way. If there is no upfront payment, that would be just fine as well. Like I said, upfront payment is just one piece, and that's the way. It's a bit of long-term financial play. Universities who actually take upfront payment, they put that into their endowment and generate additional return, but it doesn't have to be that way.
Yeah, I would agree with that completely. Right? It's one of the options, and so if it makes sense for a given owner, and it's exactly right, Santanu, that if they can take it out of an asset that currently doesn't really yield any monetary value out of them, they can't depreciate it because they're tax exempt, but they can pull value out and put it in their endowment, which can invest in anything effectively and is unrestricted, and they can certainly get some higher returns. And really the cost of capital on these monetized assets is quite low, really. And so even though it's a private finance transaction, the overall cost of capital is quite low. And there is certainly an ability there to arbitrage that asset and improve returns for their endowment. So yeah, but it isn't for everybody, and it really does depend on what those goals and objectives are for that university or a provider.
No, that's great discussion. I do have some follow-up finance types, but we're finance type questions there. But Laura's going to pick up on sort of the finance stuff a little later, so we'll just defer sort of the finance piece till later, but definitely some follow-ups on how we finance this. So next question, and why don't we start with Santanu? What assets or services are typically included in a P3? And obviously, you know, each university or healthcare facility or corporate campus might be different. But is there any limitation on the services that you can provide? You know, does it involve everything from wiring and wireless communications to chilled water, hot water, steam, sewer, general water? Walk us through what can be provided in these.
Yeah, you are right, exactly, Jason. So in the end, the idea is providing a full comprehensive solution for the utility system, and that could include, and that typically include your central plant, the steam, hot water distribution system, electrical distribution system, domestic water, and then it could even include the wireless communication infrastructure at the campus. Buildings are very much necessary. The buildings, they're probably less investment for time, and they are reaching to their end of their lives, where you would have to provide services in the mechanical rooms, the distribution system inside the building, ECM, energy conservation measures. So all of these the utility system. More and more comprehensive it is better manageable, because the concessionaire, the partner here, can actually provide all these services under one single umbrella. And if you think about Iowa, OSU, they are very comprehensive. Even Fresno is pretty comprehensive in terms of the infrastructure distribution, as well distribution infrastructure, as well as generation infrastructure. You can talk about implementing, e-mobilities at the campuses, solar, battery storage, other kind of renewable technologies you can deploy over time. So sky is the limit. You can pretty much include anything and everything. And in most cases, when universities and healthcare campuses, they seek P3, they do seek a more comprehensive services.
Thomas, any thoughts on that? Or anything unusual you've seen that you're like, wow, I wasn't anticipating that being included?
Yeah, no. I mean, I think that, again, it almost goes to, the options around the different models that you can use to partner with the private sector. It's the same thing with the services. And yeah, Fresno is very focused on, thermal energy, not electricity generation. And, and then you get something like Iowa, where it's everything that the university is going to need in terms of utility services, right? So again, I think there's really nothing, in my view, that the private sector wouldn't be interested in doing. That's obviously more of a question for Santanu, but I think, but ultimately, there's a good way to structure the deal so that you can include whatever it is that owner needs, and the private sector is going to be willing and able to provide it.
Yeah, let's segue into sustainability. Santanu, I'll tee this one up for you. You talked about a little bit in the types of services. How, in the projects that you're working on these days, how important it is for the campuses is the sustainability? Is that issue number one, outside of obviously financial is obviously probably number one, but is sustainability a close second there in terms of what they're trying to achieve, and how are you helping them achieve that? What type of technologies are you coming to the table with to help them achieve that?
Mm-hmm. Exactly right. So Jason, I think campuses have typically two major goals in their minds. One is resiliency and one is sustainability. And that we have pretty much seen that with all the campuses we have been working with. Some campuses have their 30-year zero carbon goal. Some campuses have 40-year zero carbon goal. And these goals are a bit of moving target, because as technologies are evolving, you are able to deploy more and more commercialized technologies at the campus. Sitting today, I don't think that there is one single technology that you can say, okay, I can make the campus carbon free, and at the same time, be cost neutral, right? So there is nothing that exists. You do have solar and battery storage, but then when it comes to the heating the campuses, there is not one single solution. You could go for electrical heating, complete electrical heating and cooling, but that's going to be very expensive. So the idea is that you deploy technologies over time. Today we are also talking about hydrogen, for example. That's one way to completely decarbonize a campus, but there are regulatory issues that we have to be faced. Hydrogen is also not a cheap technology today. Even if you got a way to burn hydrogen, how are you going to get hydrogen to the campus? I think that's another big issue. And if you are getting hydrogen through trucks, then you are not decarbonizing the campus. So the idea is that it's going to go over time. It's going to evolve over time. You have geothermal that we are looking into for some campuses. So it's going to evolve over time, and over time you're going to deploy more and more technologies and really put forward a carbon-free pathway for the universities to get. In the meantime, you can also get some of the energies outside of the campus in terms of virtual PPA, for example, renewable PPA, and that's another way to partially meet the decarbonization goals. And over time, time and time again, you're going to look at new technologies to deploy that, and then you replace those virtual PPA with the real generation system at the campus, if that makes sense.
Shantanu, do you build any flex sometimes into you've got some long-term arrangements, and obviously technologies change at a rapid pace. Do you build in flex into those agreements to upgrade and change, let's say 20 years in, to maybe there is a way to go completely carbon-free or some new technology? How do you deal with that in the contracting?
That's a good question, Jason. And I think the way all these concession agreements are set up, if you think about Ohio State or Iowa or Idaho, they actually provide that kind of flexibility in the contract, because these campuses know that these are 50-year partnerships, and there will be things that we cannot foresee today what's going to happen 20 years, 30 years from now. So the agreement actually itself provides that kind of flexibility, where you can actually look at new technologies. The concessionaire and the partner, they're going to basically look at different new technologies over time, and they're going to develop new technologies over time, and they're going to bring it to the university for their approval. And if those projects are approved, then you deploy those technologies, you make those investments, and they're paid out over time under pre-agreed form. So that provides that structure. That framework provides enough flexibility to look at different technologies and deploy them over time.
Jason, if I could jump in on this.
Yeah, absolutely.
So as I mentioned earlier, what I've seen is for a lot of these owners, the utility systems aren't core to their everyday, right? So, right, they want to be greener, they want to operate more efficiently, but their utilities isn't the first thing that they're focused on. And by partnering with a private sector like ENGIE, whose core focus is utilities, I think that they can then get somebody involved who's going to be minding the store and trying to do that strategy and forward thinking around where can I make improvements in the future years so that we can start to get that, get down to that carbon zero threshold. And do that kind of planning against that. Just for many of these owners of infrastructure, it isn't top of mind for them, but it would be for someone like ENGIE. But also I think just the way that you can set up the P3 arrangement, it can be set up in a way that you're aligning incentives, right? So the payment mechanism can be set up such that there are, there's a way to ensure that, certain targets are met over time, for example, right? And so you can certainly tie some of the compensation to performance for sure, including energy savings. And actually, in fact, on the Fresno transaction, we have an impact bond structure where, frankly, to the extent the private party isn't able to achieve the energy savings that were initially intended to be achieved, they'll actually pay a higher rate on the debt. And so they're keenly focused on ensuring that they meet those targets. So I think through contracting in a variety of ways, you can really incentivize that private party to achieve the goals of the public sector owner of this infrastructure.
Mm-hmm.
That's great.
And one thing to add to that, maybe just one quick thing to add to that is also these concession agreements type, in addition to what just Tom said, they automatically incentivizes the concessionaire to look and explore new technologies because, more and more they bring new technologies to the campus, more and more investments are going to come and they're going to make bigger return out of that. So that's an automatic feedback loop in incentivization by which you can actually bring new investments, new technologies to the campus.
Exactly.
Question for you, Shantanu. I think I know the answer to this, but I noticed that most of these are done on a consortium basis lately. You and I have obviously worked on a transaction involved a consortium. I mean, I think what are the universities? Would you prefer to do it as a single provider, or do you view a consortium as kind of the best approach, given the size and scope of some of these projects?
The larger projects definitely have consortium, they have great benefits because typically in the consortium, what you have is you have a technical partner, you have an O&M partner, and then you have investment partners. So, and then you have the investors, you got financial investors and strategic investors, and they come in with different goals in their minds, right? The financial investors obviously can bring cheap money, but at the same time, other kind of, thought process and, other kind of structural benefits to the overall consortium. And then you obviously have the other O&M provider who are mostly going to focus on the O&M side of it. Risk is allocated in such a way the overall cost of capital at the consortium level, at the SPV level, is minimized. So bigger are the transactions, you can actually make these much more efficient in terms of structuring with a consortium. But then in that case, when the transactions are smaller, obviously that brings a lot of cost. That adds a lot of cost, which is going to be hard to recoup. So, for a smaller transaction, maybe a single provider is more suitable, and vice versa. But it just depends on how big the transaction is, how you can actually structure it more efficiently. I don't know, Tom, you have other thoughts there?
Yeah, no, I think you're right on there, Shantanu, and I think it really depends on right on that risk transfer spectrum, all the different models that were outlined earlier. If it's a pure O&M agreement, then a single service provider is a pretty easy, leap to make. But if you're looking for someone to come in and rebuild a whole bunch of your infrastructure, and have to design it and build it, finance it, operate, maintain it for 30-something years, then there probably aren't as many folks, single entities out there that can do all of that. And so they will need to bring in others. And so you'll just have the desire there to really bring in folks that are best in class across those areas, so you get the best in class overall solution. So it really does depend on the ask to the private party and what they're really being, meant to do as part of that agreement.
Next question before we jump into financing is just risks, and maybe I'll go with sort of dueling risk profile. I'll have Shantanu talk about risks to the sponsor, and then I'll have Thomas talk about risks to the campus. What risks are out there, when you're structuring these?
And there are definitely different types of risks that we're talking about, especially when you're talking about 30-year, 50-year contract, Jason. You have the design, build, implementation risk, you have financing risk, you have investment risk over time. There's tax, there is insurance. Insurance is a big factor of it. How do you really structure it in a sense that some of the insurance risks that university doesn't have to, or the healthcare facilities don't have to retain, they can actually transfer it over to the partner. Tax is an important aspect of it because you are talking about public-private partnership, right? So public is really your public universities. They are public tax-exempt entities, and then you have the private party who's taking over. So how do you really make sure that the structure is well balanced, and at the same time, the operational risks are transferred to the private party. We talked about KPIs. Typically, these concessionaires, and the operators, they are held to strict KPI regime, and making sure they are providing, what they're supposed to provide, right? So really, utilities in a way that campuses are resilient and sustainable. So definitely, they are held to the strict KPI regime. So that's another aspect of risk transfer. You have talked, you can talk about cost risk, over time the O&M cost can go up or go down, but how do you make sure the cash flow from the university side is levelized and they don't get those risks? Life cycle cost risk over 50 years for the utility system. So there are several different things that are actually transferred to the concessionaire, making sure university gets all services under one single umbrella, and risk is removed from what they are not supposed to take, which is not an academic piece of it. It's more like utility system operations.
Yeah, I would say right. Well-structured P3s are ones where the risks are allocated to the parties best able to manage them, and it isn't such that the public sector gets to push all the risk onto the private sector, and they don't have any risk retained. And if you try to do that, it'll either be very expensive solution, or you just won't get any private parties to show up. And so there's got to be proper allocation of risk. So some risks will be transferred to the private sector, some will be retained by the public sector, and others are going to be shared. And that's all part of the, all that goes through when the public sector procures this project. All that negotiation occurs really during that period, and that's generally why a lot of these P3s can take so long to get through to commercial and financial closes, because there's so much to talk about. But certainly for retained risks for universities, or any of the owners, I should say, is any kind of pre-existing environmental conditions, right? The private sector is not going to come in and if it's been an oil fired power plant or something for many years, like no one's going to want to step in and take the risk around what's existing in the ground that already. So there certainly things around pre-existing environmental risks are going to be retained by the owner. Kind of latent defects can be a risk. If the private party's got to come in and they've got to use some of the pre-existing infrastructure or build upon it or plug into existing buildings, and then they get in there and they realize, well, there's a structural problem here that wasn't intended. That kind of risk generally is retained by the owner, just because trying to price that with the contingencies would be so phenomenal, the costs would be unaffordable. And so, and then other things like energy costs, the actual cost of fuel, is oftentimes retained, as well as inflation risk. Costs that aren't fully hedged will often be indexed, and so therefore the payments from the university will be tied to an index. And so if inflation were to go up, that risk is often retained by the owner. And so, we've seen that arrangement time and time again in the U.S. and in other markets.
Yeah, I think Texas really opened eyes to some folks on just hedging and energy pass-through. So I think that's going to be an issue that will pop up probably on the risk profile, a little bit higher on the risk profile table in future deals for sure. Mm-hmm. Let's get into financing. My partner Laura Bilas is going to moderate this next part of the webinar and just talk about financing. I know one thing I want to hear about a little bit more on that impact bond. That's a truly unique structure I had not run across before, so I'm curious to hear a little bit about that. Laura, I'll turn it over to you.
Thank you, Jason. And I know we discussed a little bit overall the general structure of these monetizations and transactions, but a lot of them involve a significant upfront advance payment. And we were interested in hearing about how you see those upfront payments financed, whether it be through access to the capital market, through certificates of participation, or note issuances, or other ways in which to finance those. And Tom, maybe I'll start with you.
Sure. Yeah, generally speaking, for these types of projects, these are ones where equity is involved. And so once you've got equity involved, the ability to access tax-exempt debt, when you reference certificates of participation, become very limited. And, in some circumstances, at least in theory, you might be able to use a private activity bond. But for this type of project, there's some limited availability, and it can be challenging to get sufficient capacity for a given project. And happy to dig into that a little further if folks want to. But where we're seeing these projects mostly get financed for the long term, to finance that big upfront payment, there's a series of payments the private sector receives back over 50 years. And so it's that long stream of cash flows that's financed against. And that's, often done in the taxable bond market. And in particular, the private placement, also referred to as the 4A2 or Reg D market, is a place where you can go out quite long, 30, almost 40 years for sure. I think there's been a few instances of even going out to almost as long as 45 years. And so you can go out quite long in that market. It is taxable debt, but it works well when put together with equity. And in certain projects where there is construction risk, that market does provide a delayed draw feature to it, which kind of works like a bank loan would to help minimize some capitalized interest when that's needed. Alternatively, folks can also look to the public taxable bond market or the taxable municipal market. The taxable muni market has been getting a lot more activity over the last year or two, as as rates generally have come down a lot, largely due to COVID and Fed action. The discrepancy between taxable and tax exempts really up until recently had been negligible. And so a lot of traditional, even tax exempt issuers have gone to the taxable muni market to access capital. And so because it takes away a lot of the IRS restrictions that come with tax exempt debt. But for private entities that are looking to invest equity into a project, it'll in most cases be the private placement market for long-term debt or the taxable muni market. And so for at least for the monetizations, I would say, those are really the areas where you'd look to for long-term debt.
Yeah,
Thanks, Tom.
I would agree with that. I mean, one thing is, if you have an availability payment structure, probably have the leverage is probably going to be much higher than the upfront payment structure. But I agree with what you have said.
And so how would you see the bank market? I mean, when you look at last year compared to heading into 2021, do you see any differences? And is there a pretty strong appetite on the part of the banks?
Yeah, for sure. I think the bank market, obviously the bank market did go through a bit of a roller coaster last year for sure. And, certainly as soon as COVID hit and really impacted the economy, I think we saw a lot of banks try to take a step back and see what was exactly happening. A lot of existing clients of banks were, drawing down on their facilities and trying to, amass as much liquidity as they could. But ultimately, I think the dynamic that the banking industry saw last year was one where, base rates like LIBOR going very low with the threat of going negative. But the credit spreads above LIBOR, so the pricing of that specific type of debt widening. And so I think, the banks were in a position where they generally could be a little more selective as to how they could price projects. And so I think that's the general dynamic initially. I think since then we've seen it where, rates have started to move back up again, and conversely, spreads have started to tighten. So the kind of overall rates are maybe a little more stable than kind of what's been going on within the rate, if you will. But generally, the bank market is very open to infrastructure projects like these. It really just depends on the payment mechanism, the way in which the private party is going to get compensated. And, if it is an availability payment structure, as Santanu mentioned, so a very long series of payments over 50 years, bank debt's not going out anywhere near that long, right? They price best kind of, 5-7 years and in, they're very much on the front end of that time period. So in some instances, Probably haven't seen it much at all yet in the university utility space, but in other areas in infrastructure, sometimes a portion of the payments come in during construction or at the completion of construction. And so over that, what could be a 3 or 4 year period, you've got a set of cash flows coming in from the university or from the owner, and then maybe you've got availability payments coming in thereafter. And so we do see circumstances where the bank market participates in financing against those construction period payments with long-term bonds financing against those longer payments. And the bank market's very well set up for that. It's a good market for lenders, for borrowers that have that type of structure.
Thanks. Shantanu, would you agree with that?
Yeah, fully agree with that. We have seen the exact same thing in the market.
Great. Well, we were hoping you might be able to address, we know a lot of the folks in the audience include some tax-exempt entities, and they've been looking at these monetizations, and we were interested in your thoughts as to whether there are any additional risks or concerns that the tax-exempt borrowers would face compared to the taxable entities. Maybe Tom, I'll start with you.
Sure. So I guess at least the way I'm thinking through this, in the university context, for 20 years there's been an option for universities to finance housing, privatized student housing using a fully tax-exempt model with no equity. And for them, it's worked well. It's been a good market. It is one where the debt is not their debt. It is non-recourse to the university. So it's kind of a municipal project finance solution in my mind. We haven't seen that yet on a utility monetization, although at Key we did advise on a parking concession that was done with all tax-exempt senior and subordinated debt. But in my mind, I think if you're really looking to transfer the long-term risk of maintaining and operating that asset, and at the end of it, you want it handed back to you as the owner in a very predefined condition. There's an X amount of useful life on each of the different components, and it's got to be operating within certain KPIs, et cetera. I don't know that you necessarily get that out of a fully tax-exempt solution, because you don't have that equity owner in there with their equity capital at risk, driving the project day in and day out. And having somebody with that risk capital there for the full term of that concession is going to keep them, doing everything they can to adhere to the requirements of that contract. So in short, I would say there could be a tax-exempt solution. And it goes back to what the university's goals and objectives are. But if we really want to get somebody in here who's going to take this situation and off of our hands and do the best at reducing our emissions and being efficient, et cetera. In my mind, I do think the taxable debt and equity solution could provide a better outcome there.
And one of the issues we've seen, in terms of not necessarily doing this as tax-exempt, we've seen a lot of our tax-exempt borrower clients do the monetizations taxable, but they've previously financed some of these energy assets that are going to be monetized on a tax-exempt basis. And so they've had to address whether they can roll those assets into the financing, and because of private use concerns, have had to look at whether it makes sense to do the transaction, in terms of having to maybe redeem their tax-exempt bonds that are outstanding, which is, can be costly, particularly if there are prepayment periods, lockouts in terms of the redemption periods. And so I was just curious if you've had any, when you've looked at these transactions, if that's been sort of a killer, in terms of how do you weigh in that cost, that if the assets that they want to monetize have already been financed tax exempt and now we've got to take them out? Has that presented any issues on any of your transactions?
Yes, it has. We were working with an owner, a university, that had exactly that issue with tax exempt debt against that asset they wanted to do a concession over. And so then the question was, all right, so now we got to redeem this debt. And unfortunately, they had just done a recent issuance, and had like a 10-year par call. And so to try to redeem debt and do it in a cost-effective way was prohibitively expensive, and the project didn't move forward. But that was a number of years ago. I will say, and I'm not going to cite the exact revenue procedure, but the IRS, there's a rev proc out there that changed the requirement to redeem outstanding tax-exempt bonds just because you do put a concession over them. And so long as the kind of facts remain that, you know, the ultimate owner is the university, and they're using it for their purposes and for students and education, et cetera, then for many circumstances, you can keep that debt outstanding and not have to redeem it. So there's been a little relief provided by the IRS on that issue, but obviously you certainly would be in your best interest to make sure you've got the right counsel available to help you navigate those issues.
Great. Well, thank you. And I see that we're running a little bit late on time, so I really wanted to turn to sort of the trends and expectations. Maybe if you can address sort of the trends in the marketplace and what you foresee.
Sure. So I think, you know, this whole discussion is very trendy. I think utilities for public owners, you know, is one that we're going to be seeing. So universities are leading the way. I do think we'll see healthcare move in a major way into this space and look for private participation in their utilities, and then potentially municipalities and states as well. But generally speaking, you know, we're seeing more and more acceptance of, you know, private financing of public infrastructure, and certainly the new administration is very supportive of it. We're, you know, whether this trickles down to universities and utilities, I don't know, but certainly more funding is meant to come for infrastructure more broadly with this new administration. It's probably more geared toward transportation, I'll admit, but generally speaking, I think we see that there's potential for new funding. We see a lot of debt and equity capital, you know, eager to invest in infrastructure. And it's frankly, it's a great time to be an owner of infrastructure and be thinking about bringing a private party in, because I think you'll get very aggressive terms and conditions and pricing, whether it's a monetization or it's a rebuild like a Fresno style. So I think it's a great time to be an infrastructure owner and be thinking about a P3.
Terrific. Shantanu, anything to add?
No, I think nothing there else to add. I think a couple of things, maybe looking forward what universities and healthcare customers they could do in terms of making sure they're looking at everything before at least you know, launching this transaction. Are obviously P3 legislation in the state. I think that's very important to think about. Tax is very important point, because you have a tax exempt entity and a taxable entity. They're getting married together in a long-term relationship, and then obviously stakeholder engagement. I think that's very important, because what we have seen is if the stakeholders at the university side, you know, there are many stakeholders, and if you did not engage them properly, then, you know, things may drag out in a wrong direction. So I think those are things, you know, pitfalls to be thought about before at least launching the transactions.
Terrific. Well, I don't know if we want to open it up for any Q&A. We have gone a little bit over, but Jason, why don't I turn it back to you, and we can take questions.
We had one good question. I just want to out there. How are you guys handling? I'll throw this out to Thomas and Shantanu. How are you handling ITC and PTC tax credits in the structuring these transactions?
Well, maybe I'll just jump in there. You know, from an infrastructure perspective, we're really not seeing ITCs and PTCs playing a role in these transactions.
Okay.
I think by the nature.
I fully agree. In the concession agreement and infrastructure transactions, we are actually not able to take ITC, because in the end, the university, the asset, you know, is actually owned by the university, right, in terms of legal ownership. So you cannot take advantage of ITC and PTC.
Okay. So if you're structuring something, you know, virtual PPA or whatever, the ultimate sponsor offsite is going to take those credits, but they're not being built into the capital stack at all, or can't be. So that's very. They
cannot be part of the capital projects or the capex programs that you're going to have there, because here the university still retain the ownership, which is a non-tax or tax-exempt entity.
Right. If it's on campus, then it wouldn't work in my view. But if it's off campus, if you build a power plant, you build something adjacent to campus, and you're selling the power into the campus, maybe then that could work if it's an off-campus solution. But if it's on campus, my understanding is those are not available.
Yeah.
Okay, great. Appreciate that. That was the main question that we've got. So I think we can wrap things up. I just want to personally thank the panel for participating. I think this is really insightful for the audience. I know I learned some things today, and obviously this is one of the hottest areas in the energy and infrastructure market. So really appreciate everyone's participation.
Thank you. Thanks for setting this up, and thanks for the invitation.
Yeah, absolutely. And Maggie, I'll turn it over to you to close us out.
Thanks, Jason. And thank you, everyone, so much for joining our presentation today. Be sure to keep an eye out for the invitation to our third and final presentation of this series that'll be taking place on March 16th at 12 p.m. Eastern. If you would like to ensure you receive an invitation, please email me, Maggie Weschler, at mweschler@foley.com. That's M as in Mary, W as in Walter, E as in Edgar, S as in Sam, C as in Charlie, H as in Hilton, L as in Lion, E as in Edgar, R as in Ralph @foley.com. Thank you again, and we look forward to seeing you next time.
Thank you.